This week, we will be looking at a deep dive on one of my currently favorite indicators, which is percentage R. As most of you may know, I spent many years as the primary scanning tool. And again, notice the phrasing there. It's not like a signal generating magic button, secret ingredients. It's just a way to take a big list of stocks to a small list of stocks. And if you want to continue using it on the chart, indicators are and should be a way to help you interpret price, because they're a derivative of price anyway. So they're only telling you what price is doing or has done. And sometimes, as we'll see in a moment, they can be easier to read because, hey, it can be a developed skill to read price without support. But another reason why we might like indicators, or the primary reason, is that it helps us to take that big list of stocks down to a small list of stocks, and we can scan for mechanical conditions on a regular, daily, consistent basis that allows us to then put the chart in front of us. And what that means is that we don't have to look at every chart every day, all of the time, or flick through boring company reports and all the other nonsense that people like to do and consider it as busy work. And the reality is we don't need to do that. So let's go and take a look at the indicators. Let me get my charts back. And let's go and take a look. So full chart time. So this is not necessarily the naked chart, but it's got two moving averages on for the moment. I use these to help me with phases, as you know. Right now, this is Apple. If you want to take a look at it, we've got the 200 period moving average. We've got the 50 period moving average. And right now we would be in what we call a phase 3 trend. So, and all I'm looking at here is where is price in relation to the moving averages? That's all I'm looking at. The average prices have crossed higher. So I'm saying that we're bullish. We're also above the 200. We're also above the 50. And I'm going to categorize that as a phase 3 trend. It's a strong trend. That's what I'm looking for. So indicators help us interpret price. Can everyone see what I did there? I know I'm simplifying this just to illustrate the point, but that's how we should use indicators. They're not a signal generator. They're not a magic ingredient. They're just telling us what's already there. So give me a little yes or a little one in the chat box. Like, yeah, Phil, I get that. It's to interpret price. They're not signal generators. They're not the secret hot button. There's nothing magical. There's nothing sexy. It's just a mechanical way to say, yeah, this condition has happened. Cheers, Dunga. Thanks for the feedback. This condition has happened. So that's how I use indicators. That's what I'm thinking about. So I'm going to show you on the chart the illustration of indicators and tools to help us interpret price. But really what I want to do is, when I know what I want on the charts, I then want to be doing it, and we've talked about scanning in the past. I then want to put that indicator in this watch list and look down the watch list and say, okay, that's done, that's done, that's done. So that phases interpretation that we just went through, that's what these blue indication, these blue boxes and red boxes are. What is the average prices or the two average prices doing? And where is price in relation? So blue, 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 as I'm just circling right now to emphasize this point, that's what we just went through. That's what I'm referring as a phase 3 trend. So average price going up, above the 50, above the 200. Great, that's a strong trend. This is a stock that I'm interested in. So I can scan for that phase really easily. So now I only need to look at the stocks. If I'm looking for a strong trend, I can look at those stocks that I'm highlighting. I can skip this one, Dollar Tree. I can skip that one because it's out of sync. It's red, blue, blue. You know, it's below the 50 moving average, but I can basically see that, you know what, it's out of phase. It's in what we call phase 2 resting. So what that's telling me is that, hey, price is between those moving averages. Let's go and take a look. That's what we should see. So price is not visually now, we can see that price is moving, meandering sideways, but now it's between those averages. So that's how we want to use indicators. That's how we want to use indicators. But Phil, you promised us percentage R. I'm just illustrating the concept first. So really the tool doesn't matter. We want to know what we want. So let's take a little bit of a deep dive on percentage R. So we've looked at a trending tool. It's often referred to as a lagging indicator, meaning that lagging is it's based on price. The reality is that all indicators are lagging because they're based on price. They're only telling you what has happened to help us figure out what might happen next. So oscillator is what the category that percentage R would be. And the full name for this is Williams percentage R. The R stands for range, the percentage of range. That's all we're looking for. So the classic interpretation of the indicator, and this is what it looks like. And this is the default, for the moment, this is the default 14 period setting. And what it's showing us is where is price? Where's price relative to its rolling range? That's what percentage R is telling me, the range. And because the setting is 14, we're going to look back over the last 14 days or 14 bars or 14 candles, and we're going to look at where's price right now in relation to the rolling range. Does everyone understand that interpretation? Where's price in relation to the range? Now, an oscillator, and it makes me shudder to say this next part, is referred to as a leading indicator, which, as we've just established, is complete bullshit. It's still based on price. Therefore, it must be lagging. So we can't get any advantage to think that it's got some secret magic ingredient to predict the future. So get that notion out of your mind. Now, what it will do and what it can do, and what I'll prove in a moment, because I've got the data and the algorithm and the hundreds of years of data on lots of stocks to prove that this principle works. So proven strategy, data confirms it, but we've got to understand the principle of what a tool and indicator is doing. So in this case, it's the percentage range. So now that I know that this, and I could be using, just sidebar to this sidebar, I could be talking about stochastics. I'm not going to spell the full words. I'm not going to embarrass myself by possibly misspelling it. So stochastics is another variation of this tool. It's a little bit slower. It's a little bit smoothed. But it, in principle, does the same thing. It's like, where's price in relation to the range? And again, stochastic is just smoothing that indication out, the same indication, a little bit more. So the calculation of the tool is a little bit different. We don't need to know the formula, but all I'm trying to do is illustrating that if this looks like a spider web to you and it's not making sense, then use stochastic. It'll slow things down. It'll smooth out the data. And that's all you're doing with an indicator, is smoothing out the data. Price being the data. So therein lies the first problem. Right now, we've got a 14 period setting. So all we're doing is saying, where's price in relation to that 14 period range? And because we've got a short period setting, that's the period setting, short period setting, got a short look back period, it's given us this spider on acid type of experience. It looks like it's a mess. So if you are going to use an indicator, if you are going to use a tool to help you, I would suggest looking beyond the default setting. You want to, so the other way of smoothing out the indicator so that it helps you interpret it better and possibly more efficiently is to use a longer period setting. Now, one of the things that an oscillator is supposed to tell you from a classical point of view, when price is in the top range, so these horizontal lines, they indicate, the one I've got them on is the top 80-20, so the top 20% and the bottom 20%. So 80-20, doesn't matter which way around they are. Depending on the platform, it might display it a little bit differently. But what we have is we've got a 100% range, 0 to 100, 100 to 0. Again, doesn't matter which way around it is, 100 to 0, 0 to 100. I've marked off the 80 and the 20 level, doesn't matter which way around, it's still the top 20 and the bottom 20%. So what this tool is telling me is where's price as a percentage, that's where the percentage part comes in, of the 14 period range. So that's what this is telling me. So it's a little bit fast and it's not telling me anything that might be useful. But what I do know about this indicator is that it's useless when price is trending. Oscillators are generally considered as useless when price is trending. And because the classic interpretation of an oscillator is to look for reversals. So why should we use it classically? Why can't we just look at the tool, and why can't we just make an observation and compare price to the tool to help us interpret price, rather than think about the classic interpretation, which is overbought, oversold? Why don't we start thinking about non-standard tools? If the indicator, in this case percentage R, is useless when price is trending because it can stay overbought, that's what this area is. It can stay overbought, is the classic interpretation, for long periods of time. Well, surely that's an indication of a strong trend. Surely that's, if I'm a trend trader, that's exactly what I'm looking for. So I can use the tool in a non-standard way to help me find some of the best candidates, but it's still got that very ziggy-zaggy indication. So I'm going to look at a longer period length, and I'm going to change it from 14. I'm going to put them side by side for the moment. I'm going to change it from 14 to 30. So this, the bottom one is 14 and the top one is 30. So I'm looking back over the last 30 days. So this is about a month and a half. If we're on the calendar, about a month and a half. So 14 days, it's about 3 weeks on the calendar, and this is about a month and a half. So straight away, can we see how just changing to a longer period setting, it helps smooth out the data? Can everyone see that? So we've got visually, it's less like a spider web, and this is probably a little bit easier for us to help interpretation. So I've got a longer period setting compared to the shorter period setting. And what this does, it's going to smooth out the data, because if I'm looking for strong trends, and if price is going to continue to trend, then I would want it to stay in the top 20% or the bottom 20% of its range. That would be a good thing. Because if, again, let me say this again, if I'm looking for a trend, a strong trend, again, we've already used the averages. If I'm looking for a phase 3 trend, just like this one, that's what I'm looking for, then I want to find strong trends. So this tool, with the percentage R, with a slightly longer period setting, we smoothed out the data. When it's trend, when you see a strong trend, I should be able to see that stay in the top 20% of its range. Because when it does, what does that mean? That means that price is continuing to trend strongly up and up and up. We're not seeing a deep retracement, and it's continuing to gain momentum and move higher and chug along and move and move and move. Let me pause there. Does that make sense? Does everyone kind of understand the logic behind why I've changed the setting and what I'm using it for? Because the objective that I mentioned earlier is I'm looking for a phase 3 trend. I'm looking for strong trending price, and I want the tool to help me find those strong trends. Cool. Thanks, Anthony. Just give me a little indication. Just tap the yes, or a little thumbs up, or a little 1 or a 2. It doesn't really matter. Just let me know that we're all on the same page. Awesome, awesome, awesome. So this allows me to smooth out the data. it allows me to have this interpretation so that I can start looking for strong trending price behavior. Now, because I've done that, it means that I'm not going to see the zigzag that we see on the 14 period setting. So I eliminate the zig and the zag. And if there is a strong trend, it's going to remain a strong trend for a long period of time. That's what I'm looking for. I'm looking for price to continue making highs or holding the highs, just pausing briefly. Maybe there is a little bit of a deeper retracement. That's okay. That in itself can provide an opportunity to get on the retracement. That in itself can provide a setup. Again, let's not worry about a setup for the moment. Let's just think about how we can use the tool. So this is what I'm looking for. This is the end result. So let me take the 14 period off now, which is that one. So we've got the 14 period. Why is that? Why is that? Let's do that. Let me just refresh the data. I don't know why that's. I think my scale is just messed up a little bit. Just bear with me a second, folks. Let's change that one. Okay, that's better. So we've got a 30 period setting. And if I'm looking for price to be in phase three trend, because the moving averages, as price moves back above the 200 and the 50 period moving average, I can mechanically scan for that. But just because that's happened, it doesn't necessarily mean that price is trending. So I can stack the tool on and look for what could be a strong trend, a breakout, because price has to be, for that to happen, that combination of events, in the top 20% of its rolling 30-day range. So looking back now over 30 days, which is the setting, and it's a rolling period, I can say that price is in the top 20% of its rolling range. Again, notice I'm not saying it's overbought or it's oversold. I'm stating what's happened, and I'm not falling into the novice trap of saying, oh, it's overbought, I'm going to be a seller, or it's oversold, I'm going to be a buyer. You know, that can and it will happen. But what I'm looking for is I'm looking for context. So that's what this helps me to find. If I'm saying that price is trending and we're in phase three, I can find what could be a strong trend to help filter out the miscellaneous or false signals, essentially. So when you start to stack these things together, price is moving higher and we're above the moving averages in the context of an uptrend. Therefore, I'm looking for a continuation. So I can scan first. This is mechanical. This is one of the things that we get to do when we have a mechanical evaluation. And the percentage R is going to help me find a candidate. It's still not a guarantee because it's just doing the heavy lifting to help me find what could be the strongest trending candidates. Let's go back to the main scan. So Dollar Tree is a good example of price being above the moving averages, but visually, it's not really going anywhere. It's not really doing anything. So it's a little bit frustrating. So now that I have I'm looking for blue, blue, blue. And what I can do is I can take that percentage R indicator at the bottom and I can pop that over to the watch list. So I can also now scan, and I've had it changed a little bit. I've had this custom coded just so that it reads easy. That's all I've done there. So when it's in the top 20%, and it's also going to read price, and it's developing price behavior pullback. So I've actually had the price action coded up. So it's looking for price to be also in an uptrend, the visual trends that we just described. So that's what this is doing. So when I've got this bullish indication, and we've got we're in the top 20%. So I've got my moving averages are all pointing up. I've got my percentage R is in the top 20%. And not only that, it's telling me that for about 90 days, it's been trending strongly for 90 days. That's pretty cool. That's what that indicator is telling me. So I can look down and find the strongest trends, the longest trends, and potentially participate in a rally. And I can also code this tool up to look for retracements. So this down move that we saw yesterday is going to help me find a retracement. So I don't know if you can just read it because it's a little bit small looking over my shoulder on the projection, but you can see that we've got bull. It's telling me that it's bullish, but there's also a little R after some of them. And that's telling me that we've got a retracement. So it's reading price action in the background to help me figure out, well, not only is the indicator saying that we're in the top 20% of its rolling range, not only are the moving averages pointing up and prices above them, so we're in a phase 3 trend, it's also saying that price is putting in a retracement. So maybe I've not missed the boat on Apple after all. Maybe this downward movement in context is a buy the dip opportunity. It's a retracement in the context of an uptrend. Because guess what? That is what we're looking for as trend traders. And I can find the strongest candidates for those entry setups. So I don't have to waste time looking at charts that are not in phase. They're not trending. They're not doing anything interesting. So I'm just looking down here. Let me just draw your attention to this. Number 31, STX. This is on my universe of stocks. I'm pointing out one that I wouldn't trade for obvious reasons. We've got a blue, a red, and a blue. So prices between the moving averages, and we've got a bearish direction on the moving averages. And the moving average has been down for about 100 days. But I can also see that there's no indication that we're in either the top 20% or the bottom 20%, because that's what that blank box, there's no indication to say, you know what, we're actually in the bottom 20%. So I don't need to look at that chart. It's not telling me anything that I want to see. And this is one of those principles that we keep talking about. This takes longer to explain than to do. It takes longer to explain than to do. But if I'm looking for the strongest trends, the best candidates, the ones that are going to offer me explosive potential, then I want to know what that looks like. So if I know what the end result, and this is why we have a strategy, this is why we have, I refer to it as a production line process. It means that I can create wealth, I can find opportunities, I can look for setups, indications that are footprints that allow me to find the best possible candidates as we've just defined. It means that I don't have to flick through chart after chart after chart or read boring company reports. I can find trades, I can put them on, I can manage them. But more importantly, I don't have to spend my day looking at that chart. And this takes longer to explain than to do. So I can find candidates by looking at, well, are we in the top 20% or bottom 20%? Now, in context now, we can start saying things like, well, if I've got a bearish, so some of these are red and some of these are green. So if I've got a bullish uptrend in my phases and I've got an indication that we're in the bottom 20% of the rolling range, then maybe I can actually look for the classic entry of saying, hey, yeah, this is oversold. Maybe I can start thinking about a buy entry. It's not an automatic buy or bullish indication, but I can start making that hypothesis. I can start making that assumption before I look at the chart. I can go and see, like right now. So the yellow boxes, the yellow box here, it says bear if you can't read it. So that tells me that I'm in the bottom 20% of its rolling 30-day range. And then looking left a little bit, I want to see a phase 3 bearish trend. I want to see red, red, red. But what we can see with Grubhub, and we'll go and look at it in a moment, just so you can kind of connect the dots. I want to see red, 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 but I've got red, blue, Blue. So the last blue tells me that the average prices have crossed upwards. The golden cross, I didn't make the name up, blame the textbooks. We've got a bullish cross in the average price, but prices above the 200 and below the 50. But we're in the bottom 20% of the range. Can everyone see that there's a conflict in what I'm expecting to see? I don't need to waste time. I've got one indication out of the two basic ones that we're looking for. I don't need to look at that chart. I can go and say, you know what, if I'm looking at logging on today and I'm looking for a new trade setup, and this is the newest indication that I've got out of my top 50 stocks, you know what, I don't really need to look at that chart. There's nothing for me to do here today. So check my positions. Is there anything I need to manage? That's a conversation for another day. And I can then think about, you know what, there's no new trades today. Log off, go for a walk, have some ice cream, go to work, have a meeting, spend time with the family. You know what, it's Friday. Let's just log off and call it a long weekend. There's nothing for me to do. This is what makes it a 5-minute task. It takes longer to explain than to actually do. Just so you've got context, let's go and look at Grubhub. We know what we're expecting. There's not really a trading opportunity here. I'm expecting to see price between the moving averages. I'm expecting to see price in the lower 20% of its rolling range. It's possible that there could be an opportunity, but you know what? It's a long way away. So let's take a look at Grubhub. So we've got, there's our cross in the average price. Price is above the 200, but it's below the 50. We're in the bottom 20% of its rolling range. So this is not really something that I need to worry about today. Again, just for context, we've gone to look at it. I wouldn't normally bother, but that's what I'm looking for. So we've had the strong trend, but we've not got an opportunity now. It may provide a new opportunity, but it's not providing me anything that I need to worry about today. So over here, so when was the setup? So now that you know the secret sauce, you've got the indicator there, price in the top 20% of its rolling range, average price has crossed over. So here's your entry point right there. You could have taken a nibble on that piece of the chart there if you'd so chose to. It stayed in the top 20% of its rolling range. It tried to move out, to move lower, but again, you could have got a piece of that pie. It's a $10 move. So, you know, if you've got $1,000 risk, you know, you could have doubled your money quite nicely. So there's your trade opportunity there. So that's how we find trades. It's how we use indicators. It's why I like percentage R over Bollinger Bands for the moment. It's helping me find breakout opportunities. It's helping me find retest, retracements. It's helping me find long-term trends. I can look for time retracements and price retracements. And I'm not using it in the classical sense of looking for overbought or oversold. Just very quickly before we wrap up, just some final thoughts. Let's go back to Apple. If you'd wanted to let's go to the full chart. There we go. So if you want to use the tool, because you've got this longer period setting, you can say with a little bit of ease that maybe that is your support level from the indicator's viewpoint. So that's your support level from the indicator's viewpoint, because that was it's about 50%. There's a 50% retracement. If you like Fibonacci and you're looking for a 50% retracement, well, it tells you we're at 50% right now. There was 50%. So if that's your clarification, that's your rolling range retracement as opposed to an actual retracement. One of the difficulties with Fibonacci and looking for retracements in the context of that is, like, where do you put your start point and when do you put your end points? So this tool kind of eliminates that. You know, we're at a 50% retracements in the rolling range, and that looks good. So that would be an interesting support level. That would be a good level to say, you know what, if price goes below $90, you know, maybe that trend is over. Now, the indicator we can see here for the moment, we can see the market selling off. That second scenario we went through looks like it's unfolding. So price is going below, at least for Apple, price is going below that prior indicator low. So we're making a new rolling range low. Again, remember it's rolling range. So we're back to that 50% level. So it would be interesting to see, and this is how I would interpret it, just if we want to use price to, if we want to use the indicator to help interpret price and just take the indicator beyond what we can scan for, we can use this to help us filter. So we're at that kind of 50% range. It'd be interesting to see, and as I'm talking, it's happening, to see that price is going to react off this point. Again, I didn't say bounce. I didn't say any. It's just potentially going to react because that's where it reacted last time. And if you look left across the chart, you can see that that 50% level is an interesting pointer. It has been in the past. Again, just in the context of price relative to the indicator, 50% kind of looks important. So now I can say that, you know what, we're at 50% retracement of its rolling range. I want to correspond that with price. Let me say that last part again, and this would be a great place to finish. I want to correspond the indicator. Oh, the indicator's at a 50% retracement. It did that before, previously, and then carried on with the trend. It did that. Will it do it again now? So what I want to do is not just say that we're at 50% on the indicator, because that would be stupid. We then want to go back to price because the indicator is helping me interpret. I want to go back to price and just look left of where we're at. And I then want to look for, did it stop here previously? Well, that could be support. That looks like this, for the moment, again, obviously everything can change. I've got to put that disclaimer in. But as I'm looking at this right now, this could be a very interesting turning point for Apple. And we've already established that in context, this is just a retracement in the uptrend. But what we've done with the indicator now is just taking it to an extra level and lay it on our regular analysis and interpretation. Say, looking left, we can say that, you know what, this is probably an interesting stopping point. And based on what happened last time, we've got to say that this footprint might give us an indication. There's that name again, or the word. It might give us an indication that something similar will happen in the future. So let's see if we can check our homework, look left across the charts. Has price stopped here before? Yeah, that prior resistance on the way up may act, and we can't ever say for certain with 100% certain. I'm not going to blow wind in your sails and say it's a guaranteed. But what we can say is that the best guess, and as a novice trader, you need to let go of the certainty. But as a professional trader, someone who's doing it long term, all we can do is say, this is the analysis, this is what we see. But in the context of what we've just established, prices retraced, the prior rally up paused. That was resistance in the textbook context. Well, now we're on the way down. The indicator is giving us that, you know what, that could be interesting. That could be an interesting level. Corresponding it with price, well, actually, we're at support. If I was to then see one of those fancy big spike, small body, that would be the time that I would be saying, or right now would be the time, today would be the time that I would be saying that, you know what, that retracement move might be over and the resumption of the uptrend might be starting. We can see that happened last time. And what happened last time? It sold off, paused for a day or three, so we don't have to rush to get in the trade. It paused for a day or three and then resumed its uptrend. And you can find these footprints over and over and over again if you know how to look at the charts. And we've looked at the charts in the context of moving averages. We've looked at the context of percentage on the rolling range. 30 days is 30 periods. And all we've done is we've not done anything other than state the damn obvious. That's all charting is. Just say what you see. Do you remember that? Remember that game when you were kids, the spot the difference game? Say what you see. Does the picture on the left look like the picture on the right? Oh, it's starting to look exactly like it did last time. Great. Well, we'll probably see something similar happen again in the future. That's as complicated as we want to make technical analysis. That's as complicated as we want to make charting. All an indicator does is indicate. It helps us interpret price. And we're always going to look at price. And to be fair, as we're talking now, we can see that rally is happening. It wouldn't surprise me if we did see, if we can see a close above $120, that for me would be quite interesting for the retest. I would imagine that we would see something similar to that, you know, that footprint last time. It happened at the big crash, the big sell-off. You know, we were kind of below the averages, but nonetheless, we can see the same thing happens multiple times. So you can go and find these footprints. I think that's a great place to stop. Did everyone enjoy the session? I'm kind of pulling back the curtain on a few things, but it's just a methodology to find opportunities, to look for trades, to help you interpret price, because ultimately price is king. Price is king. I'm looking for the strongest trends, the best trends. This is the end result. Yeah, I'm waving my hands around for some reason, but nonetheless, that's what I'm doing. But does this help you, and will this help you find the next trade? Again, you don't need to necessarily take my word for it. Go and practice. First of all, I promised you some results. Just going long in phase 3 trends, promised you some results. Going long in phase 3 trends using the tool to help you find those long trades. Helps you find, sorry, I'm just getting my image up. Trading Apple on a 60-minute chart. So the same strategy we just went through on the 60-minute charts over the last 20 years. So this is 20 years of data, is going to give you an equity curve like this. So I promised you that it wasn't just a theory. This is the reality. This is how we trade. This is the strategy. We've got full details of this strategy in the training. If you would like to learn more about it, by all means, let's have that conversation. And it's inside the profits training. So if you want some help with this, and again, I appreciate some of you, this might be a new concept, but what we want to do is create wealth without worry. So if that's what you're looking for, and you need help with that, and you want to master swing trading stocks in just a few hours a day over a few short days, as you can see, it doesn't take that long to actually apply it. I can give you the quick start version. You'll start seeing results in the next 90 days or less. You'll never be flicking through chart after chart ever again. You'll never be reading through boring company reports or any of that nonsense. So if you want help with that, and you want to start the conversation and see if what we do is right for you, I don't know if it's right for you. I truly don't know if what I do is right for you, but I'm happy to have a conversation and help you figure that out. And if you'd like to do that, just send me an email to phil@antivestor.com and we can have that conversation. The strategy that we went through is the it's a very small part of the profits training program. But nonetheless, that is a deep dive on indicators, specifically percentage R. That's my favorite tool at the moment. And I truly hope that you've got a lot out of this session today. And if you want to have that conversation that we mentioned earlier, again, just one more time, phil@antivestor.com, and we'll help you. But at the very least, we'll point you in the right direction. With that said, I'll stop the recording. Thank you very much for your time. Thank you very much for your attention. And I will see you all either inside the Slack group or next week's workshop. Thank you once again for your time and attention.